The 2021 to 2022 U.S. corn available stocks to use situation continues to tighten with only 5 months remaining in the marketing year. If demand holds firm through August, the new crop buffer could be approaching levels not seen since the 2010 to 2012 3-year drought across the U.S. This could keep hold support under the corn basis market, unless non-commercial buying wrecks the market and causes a dramatic decrease in demand. I had a great question come in Monday. I was visiting with a corn buyer on the East Coast, and the subject turned to the basis market. My friend asked about this hypothetical situation. I can't state strong enough this was a hypothetical rather than prediction. If new crop corn futures go to $12, $13, or $14, will we see basis collapse similar to what happened with wheat during 2007 and 2008? This is a great question that brings up a number of key market points. First, I am not predicting corn at $12, $13, or $14, but it's interesting to think about what would happen to demand if it got there. During 2007 and 2008, wheat basis did indeed collapse, falling to $2 to $3 under, cash below futures, and setting the stage for the variable storage rate program I still argue against. To answer this hypothetical, we need to remember what happened back then that drove wheat higher. It was still the early days of the commodity fund feeding frenzy in agriculture as the industry was still adjusting to the Energy Policy Act of 2005. Add to that a drought across the U.S. northern and Canadian plains that dramatically cut production of spring wheat, yes, similar to what was seen in 2021. This drove the Minneapolis, HRS, futures market to a high $25 with Chicago rocketing above $20 and Kansas City, HRW, climbing to near $14. The problem was commercial traders weren't short of winter wheat supplies, with solid carries seen in Chicago and Kansas City spreads, eventually working out to more than 100% full commercial carry. Merchandisers refused to pay prices being set by fund traders, and basis collapsed. Looking ahead to 2022 corn, there are some key structural differences. Yes, the non-commercial side has again built a substantial long futures position, but there is room for them to add over the coming weeks and months. More importantly, though, the 2021 to 2022 marketing year supply and demand situation continues to tighten, whittling away at the buffer the 2022 crop has against potential weather problems. My end of March U.S. corn available stocks to use for corn, based on the CMDTY National Corn Price Index, ZCPOUS.CM, dropped to 8.7% as compared to the previous month's 9.1% and the previous March's 11% calculation. Meanwhile, the July-September futures spread closed March at an inverse of 36.75 cents, while the new crop DEC 22 to July 23 forward curve finished the month at an inverse of 1.25 cents. Fundamentally, corn is bullish long-term, meaning we shouldn't expect basis to collapse unless a dramatic change is seen in demand. As for the national basis market itself, the CMDTY National Corn Basis Index, ZCBAUS.CM, was calculation last Friday at 29.6 cents under May futures as compared to its previous 5-year average weekly close for the same week of 308 cents under and the previous 5-year high weekly close of 25.9 cents under. In other words, despite all that has gone on with the futures market and non-commercial activity, the NCBI was holding in neutral to bullish territory, again indicating the strength of U.S. demand. If we extend our view a bit further, the NCPI relationship to July futures finished last week at 16.4 cents under. When the NCBI rolls to July at the end of this month, the first weekly close of May shows a high of 25.2 cents under and an average of 35.7 cents under. The bottom line is, with 2021 to 2022 available stocks to use much tighter than last year, the NCBI could follow a similar path to the 2020 to 2021 market. This decreases the likelihood of a basis collapse through the early part of the 2022 to 2023 marketing year. Now, as for that $12 to $14 corn futures price, I'm not saying it won't, because as Newsom's market rule number 6 tells us, fundamentals win in the end. We'll see how it plays out.